Hi, this is Randy Finney with the Right Side of the Chart, and this is a market wrap for the week ending Friday, June 17th, 2016. It's 4:30 p.m. Eastern Time as I start this video. So the markets have closed trading for the week, and there are quite a few significant technical developments worth mentioning, particularly in the Qs, the QQQ. I made mention in the trading room that we have quite a few stocks sitting on pretty important support levels that we closed at today, and there's a good shot we're going to break those support levels next week, I think, and I'll explain why in this video. Before we get going, we're looking at a chart of the SPY. I've covered this one in quite a bit of detail lately. We have this ascending broadening wedge pattern. More importantly is the lower line that defines it, the uptrend line, very well defined. I mentioned yesterday that was support. We hit that, talked about a possible reaction, but I still expect to break down. So we did have a nice bounce yesterday, and as I expected, it would be fleeting. So that bounce was faded. Started out with a bang with a gap down today. The SPY closed down nearly 1% and was down 0.86%. And we're right on the line. We closed just about on it. So like I said, the divergence is in place. These negative divergences indicate to me that we have a lot more downside coming in the weeks and possibly months to follow. We'll see if that pans out. If we do break down, just to give you an idea, I'll just eyeball it here. And we're going to have the first resistance we have here comes in around the 203 level, and I'm not prepared to give price targets right now. I'm not even concerned in any near-term price targets. I'm in swing trade mode, and we'll just sort of see how the selling develops. At this point where we're at, I think we can start to see some real impulsive selling. We did have some impulsive selling after that fake down, that fake breakout. But let's see if what I'm looking at pans out next week. I think we could start to see some real fireworks in the market. So let's go ahead and jump over to the Qs, and we'll focus on the developments there because this is where I see really a lot of things worth noting. Very busy chart. I'm sure I have a cleaner board somewhere of this one. We'll just work off this one for now. I didn't have one prepared. Like the SPY, we have a downtrend line off the highs on the Qs. The Qs put in a high later in the year. They didn't peak until December, but we have a pretty well-defined downtrend line. A very weak, feeble attempt at a breakout. We rolled off that level and moved down impulsively. So what stands out to me more so isn't the index itself, but the sum of the parts here, the top 10 holdings. As I often make mention, the top 10 holdings in QQQ make up over half the returns. So if you can tell where the top components of the Qs are going, you can tell where the Qs are going. And where the Qs go, the market goes, because that has been our leading index for many years now. So let's dive into the charts. We'll start out with Apple. I don't want to spend too much on Apple because I don't have a very strong opinion on it, but there are some things worth noting. This is a daily chart of Apple. Forget about all the lines to the left. Look at the price action here in this critical support level. I pointed that out back in early May. This was a very key support level, well defined, and we broke below it with a very impulsive stick. Now, at the time, I didn't personally short, nor did I add it as a short trade. There's some things that give me pause on Apple. Thank goodness, because we had the Buffett rally. For those of you not familiar, Warren Buffett stepped in and just mentioned that Berkshire Hathaway, he had just taken a big stake in Apple through Berkshire, which obviously gives a vote of confidence to any stock he takes. He has almost a cult-like following. Now, keep in mind, this buying you see afterwards, that's not Buffett's buying. Buffett isn't going to tell you before he plans to take a big stake in a company. He's going to tell you afterwards. That's called pumping your book. To tell you before he takes a big stake would just ruin, lessen his entry price or increase the share price and give him more detrimental entry price. So these are lemmings. These are Buffett lemmings. I'll just call a spade a spade. People that jumped in and bought Apple because Buffett's endorsement of the stock or purchase of the stock. Now, why is this significant? A couple things I see here. I mentioned before we had this gap. It is very unusual to see a gap once entered from above or below not be backfilled. So the fact that Apple, even that Buffett momentum carried it up to there and up into the gap, well into the gap. The fact that they couldn't backfill the gap and the stock has turned back down, that's bearish technical event number one. That just shows me very weak demand. In my opinion, it's unusual to see such a clear gap not be backfilled once entered. And so that was the case so far. Let's look at the 60-minute chart on Apple. This is something I've been updating in the trading room. I put up the Fibonacci retracements from the move up. This is the entire Buffett rally. So far, we've given back. If you look to the left, this dotted line here, we're at the 50% Fibonacci level. That means we've retraced or given back half of the Buffett rally so far. Another way to say that is everybody that chased Apple following Buffett's lead, half of those people are now either underwater or flat on their position. Roughly, I'm looking at the volume weighted price. Well, actually, you can see that there was quite a bit more buying. You can see the volume price histogram. So really, this is where the bulk of the buyers stepped in. I don't know if you can make out these volume price histogram bars. So now I should say, well, we have to flip these backwards. It should be about a 60-something percent, 61.8 retracement. Yeah, so over right now about 2/3 of the people that bought, because again, I'm putting this where the volume price histogram is, and that's where shows you where the most trades were made. Actually, to do that more accurate would be right here, and then we move it up there so you can see the volume price histogram. So yeah, we've wiped out the majority of people that stepped in and bought on that Buffett rally have already been wiped out. That's how technical analysis works. It just tells you the psychology, the mentality of those people now. They're underwater. And the worse it gets, once the entire Buffett rally's faded, I think that's going to be a very bearish technical event, meaning once we get back below those recent lows, which I think will happen. Trend indicators on the 60-minute bearish. My 1333 trend indicator is bearish. So is a MACD below the zero line, both lines below the zero line. That's a bearish trend indicator. So again, I don't see any, at least not in the charts. Anything's possible, but I don't see any reason for a reversal in Apple anytime soon. And again, the one thing that gives me pause, when we look at a weekly chart, we do have, as I pointed out, there's bullish divergence potential. It's forming here on the PPO as well as the RSI on the weekly chart, and you have this bullish falling wedge type pattern. So as I said, I just don't have the desire to be long or short Apple right now, but it is a key stock, one to watch, and I wanted to point that out that at least in the near term, I don't see any bullish developments, and keep an eye on that, again, those recent lows, because if and when those go, that'll be a pretty bearish technical event. All right, let's move on to some of the things that do stand out to me right now. This is Google Class A, and you can see on this daily chart we're looking at a pretty well-defined support shelf. This horizontal line, it comes in just above the $700 level, numerous reactions, big gap back here. You can make out that gap also, and prices how the 700 level was acting as resistance before. Resistance, we gapped above it, back tested. So on a scale of 1 to 5, this is right up there with a 5 as far as a significant technical level. And Google has now fallen down to that level. I don't see anything in the charts that indicate a reversal. Keep in mind, as I pointed out before, that follows a double divergent high. This is double negative divergence. In other words, at this point, I also mentioned this potential head and shoulders pattern a while back, but more importantly, you can see at this point up here, when that left shoulder was put in, you had a divergent high. Prices corrected, went on, had one unusually odd thrust up. I believe that was an earnings-induced rally right there. Marked a high similar to the high on Apple back on May 28th last year, and then boom. So that marked a second divergent high. This is a pretty long-standing multi-month divergence, and in my opinion has a lot more to play out to the downside than what we've seen so far. So a break of this level, that $700 level, should do the trick. Let's look at a 60-minute chart. Here's one I've been updating all along. I was using the other class, GOOG, and I've posted this quite a bit in the trading room and on the front page. This one's played out as expected. Now, the one thing it hasn't done, we did. We had a reaction. I pointed out when we hit my 689 target this morning, we did get a reaction, but it was surprisingly muted. Now, today, we had some options expiring today. We'll see what happens next week. But again, what I'm getting at here is tags support. One of two things are going to happen. Support's either will be broken eventually, or you see prices reverse off support if support holds, and you see prices continue to move higher, or start to move higher, I should say. I don't see a lot here in the charts that indicate we're going to bounce off that support level. So we'll know next week. My suspicions tell me we might gap down because there's quite a few stocks, leading stocks, that are right at or above these support levels, and a couple have already broken down. We're going to get to those in a second. So very, very important stock here. Google sitting at key support. Pointed out the negative divergence in place recently on the daily chart that still appears to have a lot more to play out. And then this is a weekly chart of Google. This goes back to our bear market lows in late 2008 on Google. It bottomed before the broad market. A lot of NASDAQ stocks bottomed back in late '08, whereas the rest of the market bottomed in March '09. But pretty well-defined uptrend line, hard to argue that. And here's an even larger, more powerful divergence on the weekly time frame, negative divergence. So that indicates to me a likely trend change, meaning that sooner than later, meaning sometime this year, in the next few months, possibly in the next couple of weeks, even couple of days, that this trend line goes. And when that goes, I think it's safe to say Google's embarked on a new bear market. I think it's safe to say that already, but once that trend line goes, that'll really seal the deal for Google. All right, let's move on, look at a few more. I'm on a weekly time frame, so I'll just stay there. We'll bounce back and forth. If I don't mention which time frame I'm on, it's up here in the corner right next to the stock symbol, which time frame we're talking. So here's Facebook. Here's a pretty well-defined line. There was one weekly actually moved below, but we closed back above it. So that candlestick, as far down as Facebook went, that must have been an earnings-induced move. We snapped back up, closed above it. So this trend line has numerous reactions on either the body or the wicks, and it looks ripe to pop to me. They can't make a whole lot. Can't make heads or tails out of the PPO. Well, we can actually if I zoom in. It looked flatline when we zoom out here. But because Facebook on a weekly chart doesn't have that much trading history compared to some of the other stocks since its IPO. But you can see negative divergence into the highs as I zoom in here. So I fully expect this trend line to break, and that will mark the end of the bull market in Facebook, I believe, and take us down to this level first ultimately. And these are long-term targets, 87-ish. Down to the 73 level, and then probably I can see us coming in. Here's a longer term or secondary uptrend line, and that's probably where we'll find support, at least. But it's hard to say this far in advance. That's just sort of a mapping out a longer term plan for Facebook. Now let's zoom down. This is what is more important for next week and trading right now. This uptrend line off the August lows in Facebook. We have this rising wedge pattern defined by this line and this line here. 1, 2. This is how I draw my trend lines, folks. It's just whatever catches the most number of reactions. Sometimes I'll allow a wick or a tail or a shadow to move through a trend line. I believe this is a very valid trend line, and I see a breakdown in Facebook that also followed the divergence. Again, rising wedge in itself is a bearish pattern by nature, and when it's confirmed with divergence, I don't know, I want to say 90% or better success ratio on these patterns. So I don't have the stats, hard stats, and I think whatever the textbooks say, my actual results are probably different. But that's what I do. I love shorting rising wedge breakdowns. I love going long falling wedge breakouts. And this one looks to have broken down, and I think we have it as an official trade idea on the site. I know I'm officially short, or personally short Facebook, and I believe it also is an official trade idea versus an unofficial. So there's Facebook breaking down. We zoom into the 60-minute charts. I've been updating this as well in the trading room. This was a key level, 116. I think that's where we took the short entry. I mentioned this as an island top. You go back here, all these candlestick clusters up there. If we move this little circle, you can see this was called an island cluster. So we had a gap down. It left that island of candlesticks. So far, confirmed. Now we're 1, 2, 3, 4, 5 trading sessions later, and we're moving lower. That is confirmation of that. Island cluster tops are one of the best patterns that I've traded as far as success ratio, and island bottoms as well for going long. But so this, I don't trade these for a quick pullback trade. This tells me Facebook is likely topped and won't see these levels for a long time. Anything's possible, but that's just my experience, and that's my take and read on this chart. Now that we've had a trend line break, that further seals the deal. And then going back to that 60-minute chart, and we had this little flagging type action, broke down, ramped up, and then back test it and move lower. And these are your next stops, I believe, in Facebook. 111.67, 109, somewhere in that area. All right, let's go on to the next one. I have to jump back to the Qs for a second. Oops, too many Qs. That was several years ago when we used to have 4 Qs. All right, so next one up is Amazon. Here's Amazon. I'm on the 60-minute time frame. I'll stay here. I put up a post on this on the front page today. We had this uptrend line. It was broken. That 723 was a key level. We tried very feeble attempt to take out the 723 level, which was a previous reaction high. Couldn't do it. Fell back below, and just beautiful technical analysis. You can see how it acts as support. Broken support then becomes resistance. Tap, 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 tap. Couldn't do it, and now the stock is rolled over. So the divergent high, it's drawn out. If you draw a line from this high to that more recent high on that breakout attempt, you can see the negative divergence in place, and these are the targets on the Amazon trade. Daily chart, you can see this ascending price channel defined by these 2 yellow lines. We have one little fake out there, and now we have a breakdown, which seems to be getting underway now. And again, a divergent high on the daily chart. So the common theme here, guys, is positive. Negative divergence, multi-month, sometimes year-long negative divergence on the daily time frames, as well on the weekly time frames. This is Amazon on a weekly time frame. I don't have it drawn out here, but you can see some pretty steep potential divergence. I want to see this PPO roll over. I mean, I don't want to see it. I'm already short the stock, and we have it as an official trade idea. But once that rolls over, that PPO makes a bearish cross, that weekly divergence will be confirmed. You can already see the RSI turning down, so the divergence there. And although not drawn out here, I had that price channel. You just simply put a line from prices making a higher high versus these lower lows. So like everything else in the Qs, divergence from all the way out from sometimes the 60-minute charts, certainly on the daily and even the weekly charts. We already did Facebook and Comcast. We're on a weekly time frame here. This is the bear market lows back in early 09. You can see a fairly well uptrend line. And this forms a large rising wedge, like everything else, negative divergence. I know I'm beating a dead horse here, but trying to make the point that if the top 10 stocks in the NASDAQ 100 are all looking bearish, I just don't see how you can make a case for new highs in the NASDAQ 100. So there's your divergent high. Rising wedge, a trend line to watch. There's support. You can see the support shelf right here if and when Comcast breaks down. Again, this isn't one of my favorite, but I'm just going through the top 10. There's negative divergence on the daily chart going all the way back here to the October highs. We had these another high in November, and we punched out, tried to break out above those highs, another bull trap or failed breakout, as you can see here, right here, above the October, November highs, failed. That marginal new high put in divergence, and it appears that over time Comcast is going lower, but again, not one of my favorites. Intel, what do I see in Intel? Not a whole lot on this chart. Let's see what I can show you on the weekly. Well, here's what we need to watch. This uptrend line off the early 2009 lows, pretty well defined. We had one intra-week pierce, but we closed back above it. That's why the candlestick's green. We closed up top. And this is just a stock that's been weakening, and you can see a series of lower lows and lower highs. That's a downtrend. So it looks like Intel peaked way back here in late 2014 and has yet to see those highs and is in a downtrend. And once this trend line goes, that's the bull market uptrend line. So that'll be shattered. Okay, move it along. Cisco. We're still in a weekly time frame. Nothing screamingly bear. In fact, we took out that uptrend, that downtrend line there on the weekly chart. Let's take a look, and you can see it here on the daily chart. Here's a pretty well-defined downtrend line breakout back test. So from the glass half full, Cisco looks good. Like I just said, breakout, back test. Two things to keep in mind. Number one, birds of a feather flock together, meaning if the NASDAQ 100 is going down, more than likely it's going to drag Cisco down with it. Why is that? What if Cisco has better fundamentals? It's called forced selling. When people are selling the Qs, when the fund managers are unloading those stocks, Cisco gets sold with it. And it's just a nature of the beast. That's what happens in bull markets and bear markets. In a bull market, all ships get lifted with a rising tide, and in a bear market, they say the baby gets thrown out with the bathwater. Now the glass half empty. Look at this divergent high. We have prices making a higher high with the MACD and the RSI clearly making lower highs, and confirmed here with the MACD recently making a bearish crossover. So what does that do? In my opinion, it increases the odds that this will be a fake out or a failed breakout. Also, probably worth mentioning is, although we broke out of that downtrend line, look at this previous reaction high. Reaction highs are, especially a big reaction high like this, is an important technical level, and you can see we failed right at that level so far. So this is the real deal for Cisco. What it needs to do is power on up, break out, take out that previous high, and keep moving up and burn through these divergences, meaning undo this bullish crossover, to have the MACD curl back up and ultimately take out both this high and then this high. And that's a possibility, but as of now, again, I favor the failed breakout scenario. A couple more and we'll wrap it up. This is number 10. This is Amgen. Oh boy, it's just done nothing for over a couple of years, well over a year now. That's the daily time frame. Weekly time frame, this is a story. This is why. When you have a stock, this is called a symmetrical triangle pattern. Symmetrical triangle patterns can break either way, and you just have to respect a break of which way. Now, I've made the case repeatedly for months, even when the biotechs were back here before they peaked, that the bull market in the biotechs was likely over and a new bear market has begun. We already had quite a bear market in the biotechs, 30-something% drop, I believe. This was your primary uptrend line off the 2011 lows. In Amgen, we broke down below it and well off the highs. We had divergence, negative divergence at those highs. And in my opinion, the divergence hasn't fully played out yet. We'll probably break to the downside. But again, if you want to be safe, if you're going to short or go long Amgen, you're in a symmetrical triangle. You're close to the apex. You just wait for definitive breakout in either direction. There's Gilead. I'll touch on number 11 just because a lot of people have interest in the biotech. So Amgen's a biotech, obviously, and here's Gilead, GILD. Very steep uptrend line, as noted here, breakdown back test, and this one is in a downtrend, has been in a bear market since. Slight divergence, kind of what I talked about as micro divergence in that video I did earlier today. We haven't had the PPO curl up here yet, and the MACD started to curl up but is now pointing back lower. So these might be burned through. I'm not so crazy on the weekly time frame about these micro divergences, but something worth noting, because there is what appears to be a bullish or a falling wedge type pattern with potential divergence in place. But my guess is these divergences will probably be burned through. Also note, these two lines, I have two horizontal lines in close proximity, and they're also on a key fib, actually a fib cluster. You can just make it out here. See how that's purple and yellow together? That means there's two fib lines. I have to see which ones they are. I think they're both 38. Yeah, that's because I used two levels down here. We had this sort of reaction low here and this one here. So that's the 38. They're just coming in close. So there's prices at a 38% retracement, just below that support level. This is a pretty key level, and like I said, I do have a long-standing short position on the LABU because as these biotechs grind around, that works in my favor, the decay on that 3-time ETF. But Gilead, if you're going to look to short it, you want to wait for a break here. I have a little pause because you can see this bullish divergence. We had this low and another slightly lower low. We had bullish divergence in place there. You can see it better on the MACD. It was almost flatline divergence on the RSI. But so far, see, this divergence should have played out for more than it did. It had a little pop. We're moving back down, and you can see a potential bearish crossover here on the MACD. So I'll stop there. I think the point's been made that keep an eye, especially on some of those earlier names that I covered that are sitting right on support next week. If that level goes, maybe we gap down below it. Maybe it holds. We rally up. So if you're bullish and you want to go long, I can't make the case for it, but you go long at those support levels with a stop not below. I know I'm doing this video over the weekend, so by the time you get this, you'll if you haven't positioned already, at least you'll have a game plan on Monday going into next week. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.